If you've been trading crypto over the last few days, you have likely felt the sting of a fakeout. You enter a position on what looks like a clear breakout, only to be stopped out as the price violently reverses. These failed breakouts point to a highly engineered trap for retail traders. This manipulation is fueled by persistent weakness in the traditional U.S. stock market, which is now exerting more influence over crypto prices than any internal industry news. Look at the S&P 500 index. This chart shows a heavy macro downtrend, interrupted by a sudden, sharp upward spike that immediately curves back down. That brief move was a temporary relief bounce caused by oversold conditions, not a sign of a structural recovery. Crypto and equities remain highly correlated. As the stock market continues to bleed past that initial bounce, it acts like an anchor, dragging Bitcoin and the rest of the crypto market right down with it. Trading crypto in a vacuum right now is high risk. The broader macroeconomic environment is currently dictating these short-term fakeouts, overriding local technical signals. Looking at this candlestick chart, Bitcoin hit a defined resistance box between $71,000 and $72,000 and sharply reversed downward. This exact rejection played out perfectly. Slicing through $69,000 support shifted the market structure. Broken support flips into new resistance, creating a difficult path back up. This downward momentum is pushing the market toward a liquidity pool. A liquidity pool is a price zone where a massive cluster of retail stop-loss orders are sitting. Large market makers often target these zones to fill their own massive positions with minimal slippage. This heat map shows exactly where that money is sitting. There is a dense cluster of data points concentrated directly below the current descending price line, acting like a magnet. That is a massive downside liquidity pool sitting between $67,200 and $67,300. Ethereum is following Bitcoin's descent. It recently hit its own wall of resistance between $2,200 and $2,400, resulting in a rejection that has pushed it back into its previous lower trading range. Solana is also showing signs of stress. It is currently clinging to immediate support at $85. If it loses that line, the technical structure points to a rapid sweep all the way down to $75. These synchronized, precise drops across BTC, ETH, and SOL suggest that market makers are methodically hunting downside retail liquidity across the entire board. When volatility increases, execution speed and reliable platforms become critical. Navigating aggressive sweeps requires a setup that handles high volume without locking you out. BingX is a solid option for these conditions. If you use the partner links below, you can access exclusive VIP bonuses that provide a significant advantage when trading these sharp, liquidity-driven moves. Amidst this broader sell-off, XRP is showing a contrasting setup. While the rest of the major coins bleed, XRP is behaving differently, presenting a potential opportunity that contradicts the current bearish trend. This chart shows XRP's price on top and the RSI indicator on the bottom. While the price drops into support between 1.30 and 1.35, the RSI forms higher lows. This hidden bullish divergence signals that selling momentum is exhausted despite the continued price drop. Because XRP hit a major support wall while flashing this bullish divergence on the 4-hour timeframe, a counter-trend relief bounce over the next 24 to 48 hours is the highest probability outcome. While much of the market remains trapped by macro pressure, these mathematically confirmed anomalies provide the technical evidence needed to justify a high-probability long position. In other news, Chainlink remains range-bound. It is currently ping-ponging between solid support at $7.90 and a hard ceiling of resistance at $10, showing no sign of a breakout. Short-term bullish relief rallies in crypto rarely hold up while the broader U.S. stock market trend remains heavily bearish. Watching the S&P 500 is your primary filter for risk right now. Until the downside liquidity pool at $67,200 on Bitcoin is swept, the probability of a sustained reversal remains low. Patience at these levels is often more profitable than chasing the bounce. Technical levels only work if you have a strict risk management framework to go with them. To learn the strategy to protect your capital and survive market maker fakeouts, click the video on your screen right now. I'll see you there.